What's going on, everybody? Welcome back to the channel. Today's video, as you can see from the thumbnail, will be about fair value gaps. I'll explain how I use them, explain every single thing I know about a fair value gap and why they are really good to incorporate within your trading. If you enjoy my channel, you enjoy my videos, make sure to leave a like, subscribe, and definitely comment down below. If you want to trade live with me every single day, I trade live inside Team Bull, which is the first link down below. So if you want to try it out, come trade with me every single day and see how we actually use these fair value gaps in real time. This will be a full guide on how to use fair value gaps from basically A to Z, so make sure to stay to the end. So first, we must understand what are fair value gaps. Essentially, they're as simple as this. They're basically where buy orders and sell orders were injected into the market, creating an inefficiency within that candle. And as traders, we want to see price retrace back into those areas to see buy or sell orders get filled. Now, how do we identify these fair value gaps? As we can see here, we have a neighboring candle here on this bullish fair value gap, and this neighboring candle here coming down. So this creates the gap. This body of this candle creates the gap because there was no wicks retesting into this area, leaving buy orders stranded. Price retest into this area, buyers will get filled and continue to push this price to the upside. Now looking at a bearish fair value gap, we can see this neighboring candle comes down to here. This neighboring candle comes up to here. And we have a fair value gap formed within this red candle. And as traders, what we're looking for is price to retrace back into this area, sellers to get filled, and price to continue lower. Now, I always say this because a lot of people think fair value gaps are a strategy. They are not a strategy, and you will fail with most fair value gaps. I'm telling you that right now. A lot of people use them wrong, and a lot of people will lose money trading fair value gaps. However, if you use them as a tool within your trading plan, they can help you out significantly with entries and exits. And one other reason that I love using fair value gaps is because it really sets you up with good risk to reward. Let's move over to the charts and explain what a bullish and bearish fair value gap is and how you can use them. So looking at today's price action, we can see price dip down in the morning and then reclaim back above and continued higher with an impulsive move. And one thing I want to explain to you all is that a fair value gap doesn't need to be formed within 3 green or 3 red candles. It can be formed in 2 green candles and a red candle, or 2 red candles and a green candle. It doesn't really matter as long as the wicks of the neighboring candles don't intersect. As we can see here, this green candle comes up with a higher wick up here. This other candle is a red candle with the lower body closing right there. So we have a fair value gap formed right here. So we have a 5-minute gap right here. Now, as price continues higher, we can see, oh, wait, there's another gap right here. And this all goes into my point of not every fair value gap will work. If you use this fair value gap as a bullish fair value gap, what you're going to see is price disrespects this gap and closes below and continues lower. But if you use the lower gap, now you're getting the right entry to go long. But why is that the right entry? Well, if you take this fair value gap off the board, one, we always use the lowest or the highest fair value gap. That's one key rule I always note. You always want to be using the lowest or the highest, giving you the best risk to reward and giving you the most buyers/sellers in the area. We go here and look at the pre-market. We have a pre-market high right here, right? So we also have a pre-market high and a fair value gap created. Let's work up to a 10-minute time frame. You can see that 10-minute time frame also has a fair value gap in the same area. So not only do we have a 5-minute fair value gap, but we also have a 10-minute. We have multiple fair value gaps. We have a pre-market high. And now all we have to do is look for candle confirmation to get along. Price comes down, test into that fair value gap, test that pre-market high. Candle closes back above. And now you're able to gain a long entry with a stop loss underneath that 5-minute low. And this sets up really, really good risk to reward. As I said before, using fair value gaps is a great tool, but you have to combine it with other areas of confluence that give you and form out a full strategy. Now, as I look at this chart, you can find multiple fair value gaps all over the board. You can find a bearish fair value gap here. You can find more bullish gaps up here, right? But why are they all useless? They are useless because there is no strategy backing them. We cannot be taking just any random 5-minute fair value gap. And when it gets worse is that usually people work down to the 3-minute, to the 1-minute, to the 2-minute. And now you're going to be finding a million fair value gaps a day. See, that's the thing. People use different time frames, and I'm only working off the 5 to 10 and the 15-minute time frame. I'm using bigger time frames in order to find less opportunities, but to find more probability within the market and more probability within my setups. So it's very important to find the time frames you work off of and stick to them, but also don't take every fair value gap you see. Now let's find an example of using a fair value gap to the downside. All right, so looking at the chart, we can see we had a really strong directional move to the downside. We're respecting the EMAs on a small time frame. We broke down past the pre-market low, and we also broke through the previous New York session low, giving us signs of weakness, giving us signs of a direction that we should trade with, right? We don't want to go against the trend. We want to trade with the trend. So as this candle comes down, it closes below that New York session low. We have a lot of weakness in the market. Looking at the neighboring candles of this bearish move down, we can see this green candle close and then that red candle wick higher. So we have a fair value gap formed right here. Price retested into this area once, twice, and we get a retest of the EMAs. So not only are we retesting EMAs, we're retesting a bearish fair value gap on the 5-minute time frame, but we also get what? We get a 5-minute candle confirmation to go short. Candle taps in, closes red. We get our short entry, stop loss above that fair value gap or that New York session low. Or if you want a tighter stop loss, you put it on that 5-minute high. Price starts to move aggressively down and we're trading with the trend, right? So fair value gaps are a great tool to trade to the upside and to the downside. But again, you have to combine them with other reasonings why. All right, here again, we have another example to the downside. We can see we have a pre-market low set here. Price comes down and makes an aggressive move down. With that aggressive move down, we see one red candle, two red candles, and then the neighboring candle is a green candle with the upper wick. However, we still have a gap formed within this candle to be filled. This candle comes up, retests the 21 EMA, retest into that fair value gap, closes below, then makes a sharp move lower. As price continues lower, it's also respecting other fair value gaps to move to the downside. And looking at this aggressive move down, we can find a lot more gaps along the way. And you don't always have to use a bearish gap to the downside, right? We can look for the gaps to get inversed. Fair value gaps can be used just like support and resistance. For example, let's say price runs through a resistance level and then retest that resistance. What do traders look for? They look for it to turn to support. Exact theory can happen with fair value gaps. So we can see down here, there's been a lot of sellers in the market, right? There's a lot of fair value gaps created, but this lowest gap, price comes up, retests into this gap, makes a move, doesn't make a new low, continues higher, and then inverses this gap. This is what's called an inversion fair value gap. Now you get this inversion, what happens? Price breaks through, comes down, retest, starts making higher highs and higher lows. So again, you could be using these fair value gaps in many different ways. And it's really all up to you to build your own systems alongside these fair value gaps. And just looking on the charts, we can find so many different gaps and opportunities. Here you go. Here's another gap. Here, pre-market high aligns. It's a big gap, but price comes down, tests into that gap, makes a new high, and continues to run. We don't need to risk this entire gap. That would make no sense. What we have to risk is that 5-minute low, which makes a lot more sense, right? Because we wait for 5-minute candle confirmation. This is the confirming candle with it dipping down into this gap, closing above. We get our entry, and our stop loss is that 5-minute low. You can risk a little more if you like. It's up to you. But I typically like to risk that 5-minute low. And as we can see, this set you up with, over a 1-to-3 risk to reward ratio, right? So that is a great trade in itself. But if you just keep looking on the chart, I mean, we can go day by day and find how many fair value gaps are respected and disrespected, right? It's going to be, I would say, around the 50-50 split, right? There's going to be a lot of fair value gaps that do work, others that inverse, that work to the opposite direction. So it's all about finding those key levels and determining your trades off of those key levels as well. It's always really hard to predict where price is going to pull back towards. And that's why I always think that these gaps are the most predictable, because you can come and look day by day and find these gaps and see where price is pulling back towards. And it's typically on these gaps, right? Because you have to realize there was a lot of buy orders left to be filled in this area, right? This moved so aggressively, so fast, that it left a lot of buy orders sitting. So when price ended up retracing, buyers got filled, pushing it back up. One of the most common questions I receive about fair value gaps is how small do you mark fair value gaps? My rule of thumb on the 5-minute time frame, it typically has to be over 20 to 30 cents for me to mark it. If it's a 10 cent, 5 cent gap, I will not mark it. Let me see if I can find an example. Just to find an example really quickly, this candle comes up and has a neighboring wick all the way up to here. This neighboring candle has a wick all the way down to here. Would I mark a gap looking like this on the 5-minute time frame? Absolutely not. I would never mark a gap that small. Never. Too small. I want to see a significant move with a big area where buyers or sellers are sitting. I don't want to see a tiny move that doesn't show me much, right? If there's wicks intersecting in there, a lot of those orders were filled already, and there's not going to be that power behind the gap itself. So the biggest trick to respecting a gap and finding a gap that does respect is finding that impulsive move, then finding that gap to where price then respects and continues higher. So it's really important that you find a decent sized gap with a big move that was generated by a lot of buyers/sellers. That's basically it for the video. I really appreciate you joining in. Make sure to leave a like, subscribe, and comment down below. Thank you guys for watching. Peace.